Do you hear that? Do you hear that clock? That is the sound of time ticking on a trade deal as the March 1st deadline approaches and as the S&P 500 inches back to new highs. It does look like the market is pricing in a done deal. Bob Pisani joins us from the NYSE with more on that. Hey, Bob.
A lot riding on this. Goldman's Jan Hatzius, in a recent note to clients, made some very interesting points. He said that the market sentiment for a deal has been lifted because President Trump is expected to meet with Chinese President Xi Jinping toward the end of March. The president recently said that there was a very good chance of reaching a deal. That's important. What about that March 1st deadline? The market seems comfortable that the deadline will be pushed back with tariffs remaining at the 10% level. Now, what if it's not comfortable? What if happens with the market here? It's not comfortable with the prospects of no deal or an immediate increase in tariffs to, say, 25%. Christina Hooper from Invesco said that, quote, if talks fail and additional tariffs are applied, stocks could fall through their December 24th lows. Yikes. So how long do the markets get strung along on all this? Hatzius says a mid-March meeting with an announcement of some framework for reforms of intellectual property rights, enforcement, and technology transfer rules was a strong possibility. But a real deal, a complete deal? Well, expect a second deadline on May 1st or maybe June 1st for a broader agreement. But he says it's possible tariffs could be in effect through the 2020 election. That's not good. In the meantime, the markets are roaring. The internals are really strong. The breadth has been advancing almost every day since the December 24th bottom. New highs are expanding. Selling pressure is low. The Dow's riding an 8-week win streak. It's all looking really good right now. The S&P 500 is close to breaking that major downtrend that began on December 3rd when it closed at 2790. Now look, we closed today at 2779. That's a few points shy of recovering all those December losses. But many strategists are cautious now because the good news of trade talk momentum, the Fed on hold, and strong market momentum has been offset by clear signs of slower global growth in Europe and China and even in the United States. And remember something, U.S. earnings expectations are near zero for the year. And generally that's not positive for the markets. Back to you, Melissa.
All right, Bob, thank you. Bob Pisani at the NYSE. So here's the question. Have the markets priced in a trade deal? BK.
I think it's largely priced in a trade deal. I mean, we talked about this last week. We've had a tremendous rally off the bottom. As long as they're moving the ball forward and they put some kind of wireframe around what this deal is going to look like, I think it's going to be okay for the market. What was interesting today is there were some headlines out there that as part of the deal, they'd negotiate that the RMB, the yuan, would not rise or they wouldn't devalue the yuan. Sorry. So that would put a lid on the dollar. That'd be an implicit weak dollar policy. That is actually very positive. So while I am cautious that we could have a sell the news event, given what we know, if you get something like a weak dollar event, that would be very positive, something the market hasn't priced in yet. Other than that, I think most of it's priced in, and I'd be concerned about a sell the news.
What I think is interesting about this, this calculus is that you have a Fed that's also during this time basically stepped to the sideline, and that was the most important dynamic, to be clear. So we got a Fed boost in the middle of waiting for a deal, and I would argue that the Fed took the life out of this deal. If I look at it in terms of the stocks that were most affected by the talk of trade, so industrials, some of the commodity stocks, I would argue that they have not priced it all back in. Emerging markets, as measured by the EEM, for example. I think you could actually see a follow-through. But during this time, we've reassessed the global economy. We've reassessed global growth. And I think that's the problem with this analysis now. So industrials have outperformed the S&P by 650 basis points since December 24th. And that's a pretty good outperformance.
Yeah. And if we do get a deal, that raises the question, does the Fed step back in? I mean, if the Fed has stepped to the sidelines in this period where we have no shot.
Not right away. Not right away.
Not right away.
You'd have to see. I frankly think the Fed's going to announce that they're going to tolerate higher inflation. Mm-hmm. I think they're going to target 3 and 4% inflation. So I think it's going to be an awful long time before the Fed steps back in.
All right. Well, our next guest says a trade deal is not all priced in. A strong trade deal could unleash a market rally here. Let's bring in Savita Subramanian, the head of U.S. equity strategy at Bank of America Merrill Lynch. Welcome back, Savita.
Thanks. Great to be here.
Let's make clear when
Exciting
you say, a deal,
Yes.
That's a real deal. That means
this is a
everything.
real deal. Yeah. So I would agree with you that kind of a partial deal, which is no new tariffs, but we don't roll back any of 2018 tariffs. That's largely priced in, and I would sell the news on that one. I think the market might sell off a little bit. But if we get the real deal, so this is where you roll back the tariffs from 2018, which I don't think is priced into the market. That would add at least 1 or 2 percentage points of earnings growth to 2019 that's not in the numbers. And then you also get this huge lift from the multiple. And you know what I think is really interesting is that ever since February, we've noticed that CapEx guidance has started to come down pretty dramatically. So I think all the animal spirits that were negative for the last 12 months could actually flip back to positive. You could see growth trends resume, et cetera. But that's predicated on the assumption that we get full deal. So we get a rollback of 2018 tariffs. We get some sort of agreement and enforcement of intellectual property, the landscape on intellectual property. And I think this whole trade rhetoric, this whole trade story is about tech. I mean, to me, it's not about, soybeans. This is about technology. So I think that might be the most important piece of the puzzle is if we start to see some moving forward on intellectual property agreements.
So this real deal scenario yields up 5 to 10% on the S&P from here, basically.
Exactly. And that's basically, I mean, the kind of the rough math, nothing's ever perfect in this world, but the rough math here is that you get maybe a 1 to 2% earnings boost, and then you get all of the multiple compression that we saw from February of last year to now reversed, essentially.
Under that scenario, I'll ask you the question, is it possible that the Fed steps back in, and does that then box the markets in the progress?
Yeah, I mean, it's sort of these counterbalancing forces. I think the Fed could tighten. The Fed could hike in the face of better growth, and I think the market would actually be able to tolerate that. I think that we've had a market environment where everyone's spooked by tightening from super low levels. But let's remember where interest rates are. They're in like the lowest 10th percentile right now. I mean, interest rates are really low. They're not going to, 25 basis points higher isn't going to ruin the corporate balance sheet of your average S&P company, right? So I think that, if we get to a point where some of the trade friction is resolved, we have a healthier economy, we have companies starting to spend on CapEx, all the animal spirits unwind again, the Fed can actually tighten without totally destroying the markets.
Quickly, Savita. So, yeah. I mean, the market seems to think when President Trump is ready to make a deal, there's a deal to be made. Are we underestimating the resolve of the Chinese?
Well, the Chinese have a much longer time horizon than Trump does. So that is that's certainly a point of contention. And I think, what this comes down to is who's going to be the next tech superpower. So, and that's a much bigger issue than whether we, raise prices on China imports.
But how do they solve that? Because it sounds like you think they could get there.
I mean, we think that they could make progress towards that, and that's the goal for, on the U.S. side. But, you're right. It's not a clear-cut process. It's a messy, ongoing process. But I think if we start to hear noises that they're making any sort of progress on tech and intellectual property, that would be seen as a huge positive for the market.
So where do you think the best risk-reward is to go to in terms of sectors if your premise holds
up? If our trade scenario holds
up? Which I agree with.
So I like industrials still, even though they've rallied pretty significantly. I mean, I think industrials is a sector that was basically pricing in full-scale trade war and a recession, like kind of everything bad by the end of last year. The other thing that I think is really interesting about industrials is if you look at the ownership of industrials by your professional investors, your mutual funds and your hedge funds, it is almost as hated as it's ever been. Nobody wants to touch industrials. I think now they're starting to be more interested. But there's not a lot of positioning risk, and the sector is basically pricing in really, really weak growth. So if we avoid a recession and we avoid a trade war, I still think there's upside risk to the sector.
Your year-end target is 2,900, which is about 4% upside. So where does it fall in terms of your scenarios for trade?
Yeah,
what is that dependent on?
So our year-end target is assuming we get kind of the medium resolution, not the real deal. So we get no new tariffs going forward. We start to see companies, they can start planning again after, living in this uncertain world, and that moves earnings higher. I mean, I think what's also interesting is that earnings expectations right now for the full year are about 4%. I mean, that's really low relative to the average expectations of analysts at this point. So I don't think that's a bad thing. I think what we've noticed is that when expectations are really low, that's generally when the market actually does really well and it surprises to the upside. So I think that there are a lot of reasons to be bullish right now.
Savita, great to see you. Thanks
for
coming by.
Great
Savita
to be
Subramanian
here.
of Bank of America Merrill Lynch. Positioning, that's very important. Positioning in terms of the markets overall, positioning in terms of sectors like the industrials.
Yeah, and she's right to mention it broadly, but then so you step back and get granular. I mean, Boeing went from 380, an all-time high, to sub 300. And in a month and a half, the stock is now $416. I mean, think about the move Boeing's had. So, again, Boeing's telling you maybe they are, to BK's point, maybe a lot of this is priced in. I'm not sure. My point is I'm not certain. We all seem to think when President Trump is ready to make a deal, there's a deal to be made. I'm not certain that's the case.
I don't know. I mean, if we get a deal like Savita's talking about, something more than the market is even thinking about, I don't think the market's thinking about some kind of rollback of tariffs and a full tech deal. That, to me, seems really aggressive. I'm not saying it can't happen. I'm just saying
You're
that
saying by March 1, or you're saying
I would
in
even
general?
say mid-year. But if we're moving in that direction, I think it's positive. But to me, there's some kind of pullback coming here. We've priced a lot of this in. I'd much rather be a buyer when the deal falls through, or when the Fed does a little bit of a scare, like, hey, maybe we're going to come back in the market, and we get a little bit of the froth off of this market. I feel a lot more comfortable.
Well, New York Fed Williams out there today basically saying we're going to need a lot more inflation than we have for us to do anything. So, we've all said this. Look, what's outperformed? Values outperform growth. And that's part of our Amazon discussion. I should have brought that up. Silly me. Bottom line here is I think you actually continue to see industrials outperform and those valuations that make sense.